In this video, we're going to compare two strategies, the covered call strategy and the poor man's covered call strategy. We're going to see which one is actually better, when to use it, what is actually the things that you need to look at when to consider using this type of strategy, so hopefully it's useful for you and you know what to do in your own trading. But before diving into this video, if you find this video interesting or helpful and you actually learn something and you like to see more videos like this one, please consider subscribing to my channel. I'd really appreciate it. So before comparing really the covered call strategy and the poor man's covered call strategy, we need to understand what is a covered call in the first place. The covered call strategy consists in buying 100 shares of a stock and selling calls against those shares. The purpose of this strategy is to take advantage of a stock, for example, staying where it is, like ranging, or for example, going down a bit, and by selling calls, you're going to collect premium, and that's what a lot of people are going to consider as income strategies, because you're going to sell calls again and again and again. It's going to reduce your cost basis, and it's a very famous strategy. Very often when you start getting into options, you will hear about the covered call strategy pretty quickly. It's very famous strategy, and it's a great strategy if you have 100 shares of a stock, and instead of, for example, just losing value on your shares because the stock is going down, you could sell calls against those shares so you can take advantage of those down moves and actually be paid for that. That's the covered call strategy. However, there is what we call the poor man's covered call, which is actually a very good strategy too. There is really good advantages in using the poor man's covered call strategy. That's why I wanted to compare those two strategies together so you can see the main differences between the two. The poor man's covered call strategy, or PMCC, consists in buying a long dip in the money call in a far out expiration and selling calls as we would do in a normal covered call. So the difference between the covered call and the poor man's covered call is that you're not buying 100 shares when you're using the poor man's covered call strategy. Instead of buying 100 shares of a stock as you would do in a normal covered call, you're going to buy an in the money call in a very far out expiration. And what I mean by this longer dated expiration, it would mean, for example, let's say 3 months out at least, meaning that you're going to choose expiration that are going to expire in 3 months minimum. That's how you're going to choose your long in the money call. And by buying a call that is very deep in the money, in a very far out expiration, what you're essentially doing, you're going to replicate a stock position but at a very much lower cost. It's going to act as a stock replacement, as if you had 100 shares, except that you don't have 100 shares. You just bought one contract and it costs a lot less than actually buying 100 shares. The downside of that is that as you bought an option, your option is going to lose value on a daily basis, and the closer you get to expiration, the more value you will lose on a daily basis. That's called the time decay. So before going further into the differences and me going into more explanations, if you have to remember one thing, first of all, right now, the difference between a covered call and a poor man's covered call is that in a covered call, you're going to buy 100 shares, and in poor man's covered call, you're going to buy an in the money call. Now that we understand that, let's go further into the explanation, into the analysis, so you can really see the advantages and disadvantages of, for example, using the poor man's covered call over the normal covered call. The first big difference when you compare those two strategies together comes down to the buying power required. The buying power is how much money you need to put on the table so as to open your position. For example, if you buy 100 shares of a stock costing $100 per share, then you will need to put on the table $10,000 because you buy 100 shares of a stock costing $100 per share. So 100 times 100 is equaling $10,000 of investment. That's the buying power that is required so as to, for example, buy 100 shares. So as I said, the big difference between the covered call strategy and the poor man's covered call strategy is in the buying power required so as to open the position. And let me give you an example so it's completely clear. Let's take the example of Apple, so we can compare the two strategies and we can see the difference in the buying power required between the poor man's covered call and the covered call strategy. If we're buying 100 shares of Apple right now and the stock is costing around $121 per share, then it would cost us around $12,150 so as to buy 100 shares of Apple. And then once you have bought those 100 shares, you could start selling calls against those shares, and that's how you're going to do the covered call strategy, a normal covered call strategy. Now, if you want to use the poor man's covered call strategy instead of the covered call strategy, then you're not going to buy 100 shares. You're going to buy a deep in the money call. If we go, for example, into the January 21, 2022 expiration, so in 1 year, and we look at, for example, the strike 87.5, the call is going to cost $37.55. And as one call controls 100 shares, then the premium for that call, if I was willing to buy that call, then the premium for that call is going to be $37.55 times 100 shares, because one contract controls 100 shares, which would equal a buying power required of $3,755. So that would be the amount of money that I would need to have right now in my account so as to buy one call, one in the money call with the 87.5 strike in the January 21, 2022 expiration. So if you don't see the difference between the two buying powers, let me show it to you so it's completely clear. On the one hand, when I'm using the covered call strategy on Apple, I need to buy 100 shares. That results in a buying power required of around $12,000. And if I use the poor man's covered call strategy, I'm going to spend $3,755. Technically, this is really the same strategy that we're going to do. This is really the same mechanics that we're actually looking to do when using the poor man's covered call strategy or covered call strategy. And you can see that there's a huge difference in the buying power. And to be exact, using the poor man's covered call strategy over the normal covered call strategy, where you have to buy 100 shares of a stock, makes a buying power reduction of 70%, meaning that you're spending 70% less by buying this deep in the money call than if you were buying those 100 shares. That's a huge buying power reduction, meaning that you can really do so much more with your money now, because you don't need to buy 100 shares of a stock. Why not just buy an in the money call? You're going to spend so much less money. And one very important thing is that the amount of money that you invest is technically what you could lose if the stock was, for example, plummeting to zero. And as you're spending a lot less so as to buy this call, then you're risking a lot less in the strategy compared to if you were buying 100 shares of Apple right now and the stock falls to zero overnight, then you lost your $12,000 worth of investment. The 100 shares that you bought, resulting in $12,000 worth of buying power, then you lost it all if the stock falls to zero. Compared to if the stock falls to zero when you use the poor man's covered call strategy and you bought that in the money call, then you just lost $3,755. So of course, this is still $3,755. This is still a lot of money, but you get my point. Compared to losing $12,000, losing $3,700 is really not much. I mean, 70% less. So it's really worth using the poor man's covered call strategy when we look at the difference in terms of buying power. And if we take the example of Tesla went down a lot these recent days, but still, if you were willing to buy 100 shares, then you would need to spend almost $60,000 so as to buy 100 shares of Tesla. And if we were buying, for example, for the poor man's covered call strategy, a deep in the money call in the January 21, 2022 expiration at the strike 400, then we would only spend, of course, $25,000. And that results in a buying power reduction of 57%, meaning that you're paying 57% less than if you were buying 100 shares of the stock, which limits your downside risk because you're investing less, as I said, in the case of Apple. And in my opinion, the fact that you're paying so much less money, because you see that it's not a 20% buying power reduction. We're talking about 70% buying power reduction, 56% for Tesla, for example. So those are big buying power reduction. Those are not small numbers. And the fact that you're risking so much less money, because remember that the big downside risk of the covered call strategy, of the poor man's covered call, is on the downside eventually. And because you invest less money right from the start, then it's going to be much better if the stock falls to zero, because you won't lose as much money. And the ultimate risk is on the downside eventually. So if you invest less, then you're going to risk less on the downside, which is a really good thing. And there is one other very big difference that I wanted to bring up, because this is really important in my opinion. There's something called the return on investment. The return on investment refers to how much money you get in compared to how much money you put on the table. For example, if you put $100 on the table and then you get $10 back, then you have a return on investment of 10%. This is what we call the return on investment, and you can really see that when you're actually trading options. You can really calculate this return on investment, return on capital, as we can also call it, so you can really have an idea of which trades are actually bringing the most money compared to how much money you put in at first. And to give you a really quick example of how useful it can be when you look at, for example, the different return on investments on the different strategies that you use, imagine that I present you the following case. I'm going to show you a strategy that is going to bring you $50 for every $100 invested, and the strategy B is going to bring you $1 for every $100 that you invest. So which one are you going to use? Of course, you're going to use the strategy A, because it's bringing you more money when you put $100. It's bringing you $50 for every $100 that you invest. So of course that this is going to be a more profitable strategy. And we talk about capital efficiency in a way that the dollars that you're actually going to put into that strategy are going to bring you more money in the long term, and your capital is actually going to be very efficient. That's what we call capital efficiency. So the return on investment is very important. You really need to look at this so as to understand how much money you're making. And I think that there is an English saying for that. It's like making a big bang for your buck or something like this. So let's look at examples of the covered call strategy and poor man's covered call strategy in terms of return on investment to see which strategy is actually bringing you the best return on investment. So if we pretend that I'm doing a covered call on Apple, then I'm going to have to buy 100 shares of Apple as we talked before, so it's going to be around $12,000. Then I would need to sell a call. So for example, I'm going to go into the April expiration, which is going to expire in around 40 days. I'm going to go for the 30 delta strike, and I'm going to collect a premium of around $310. And to find out the return on investment, I need to divide the money that I'm receiving by the initial investment. So I'm going to divide $310 by $12,000, the initial investment, and I'm going to find a return on investment of 2.55%, meaning that I'm going to make 2.55 return on investment. So now let's look at the poor man's covered call to see the difference. So as I said, I will need to buy a deep in the money call. For example, in the January 21, 2022 expiration, I would go for the 87.5 strike, and that would result in a cost of $3,755. So that's my initial investment. And let's pretend that I'm selling the same call in the April expiration and I'm collecting $310. So if I divide $310, the money that I'm making, by the initial investment, $3,755, then what am I getting in terms of return on investment? I'm getting a return on investment of 8.26%. So you see that for my poor man covered call, for the same trade, I'm going to collect 8.26% compared to normal covered call where I'm getting 2.55%. I'm making around 3 times more when using the poor man's covered call compared to using the normal covered call strategy. And on top of that, I'm risking a lot less money because the initial investment when using the poor man's covered call strategy is a lot cheaper than going for the normal covered call. And I'm making a lot more return on investment. So this is really cool because for a small account, if someone has a small account and they want, for example, to use this type of strategy, then absolutely 100%, I think, or at least in my opinion, that's only my opinion, I think 100% go for the poor man's covered call strategy compared to the covered call strategy, because if you don't have the capital to buy 100 shares, then it may be better to go for the poor man's covered call strategy because you're going to pay less in terms of initial investment, you're going to risk less, meaning that if the stock goes to zero, you're not going to lose as much as if you had bought 100 shares of a stock, and it's going to bring you a lot more money compared to the money that you put in. The return on investment is a lot bigger, as we saw for our example. So should you go all in for the poor man's covered call and completely forget the covered call strategy? Now, I don't think that you should absolutely go 100%. I'm showing the difference between the two in terms of buying power and return on investment because I think it's interesting to understand this concept of capital efficiency. In my opinion, I think that the poor man's covered call is very appealing for these two reasons. The fact that you put a lot less in terms of initial investment and you're really going to make as much as if you were making with a normal covered call strategy. I think that both strategies have their place, and for example, depending on how you're investing yourself, maybe it would be better to use the covered call strategy or the poor man's covered call strategy. Personally, I can tell you that right now, from the beginning of 2021, I've been using a lot the poor man's covered call strategy, and I plan on doing a more detailed video on how I, for example, trade them, what are the things that I'm looking at, because I haven't really described why I'm choosing the strikes that I'm choosing or the expirations that I'm choosing, but I will make a video on it quite soon, no worries. And to be honest, maybe I'll change my mind later on this subject, but for the moment, I really see the poor man's covered call as a better alternative compared to the normal covered call strategy, because now the stock market is going so high that really the big risk is, honestly, even though the big risk is always on the downside, when the market is so overextended as it is right now, well, I think it's really better if we use a strategy where we have a cheaper initial investment so we risk less money, and on top of that we get the same amount of money, meaning that we're going to earn the same amount of money by the calls that we're selling. So why not using the poor man's covered call strategy so you can protect a bit on the downside, you can have a better return on investment compared to the covered call strategy where it blocks so much money. Because if you were willing, for example, to trade Apple and the covered call strategy on Apple, you need for a fact at least $12,000. And to be honest, you need a lot more than this because you couldn't just put your whole portfolio into one stock. So you would need to have a lot more money than this. Compared to buying a deep in the money call in a far expiration, it can really be a great alternative so as to use your capital in a better way. Personally, I think it's really an amazing strategy. I've been using this on CCL, American Airlines. I mean, those stocks have been great so as to use the poor man's covered call strategy on. I hope you find this video interesting and helpful and you saw some differences between the poor man's covered call strategy and the covered call strategy. If you'd like to stay updated for the next videos that I'm going to upload on my channel, then consider subscribing. As I said, it's really an amazing way to support me and I'd really appreciate it. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.